Okay, good afternoon, everyone. Today we will be discussing on acquisition during the year, the impact that plays in the whole process of consolidation. Okay, on that premise, we are going to discuss what acquisition during the year means, what is a special requirement with respect to identifying the net worth of a subsidiary as at acquisition. How do we go ahead in splitting reserves into pre-acquisition reserves and post-acquisition profit or losses? And we'll now end up by looking at a practical illustration to end up our discussion for the day. Okay, and that's what we're going to do. Okay, acquisition during the year implies, or sometimes it's called media acquisition, but I prefer to use the word acquisition during the year. Why? Because if we assume the year runs from January to December, from all what we have been doing before now, we assume that acquisition either takes place on 1st of January of that year or takes place as at 31st of December that year. But is there a convention or rule that requires that acquisition should only be recognized at those endpoints? The answer to that is no. But for simplicity's sake, we only try to teach principles of consolidation from that perspective. The question then is, let us move from a hypothetical scenario to a practical scenario. Moving to a practical scenario means that acquisition can take place anytime in a financial year. And if that is the case, what would have happened if acquisition took place 31st of January, a month after the year has commenced, or took place 30th of April, 4 months after the year has commenced, or took place 1st of June, 5 months after the year has commenced, or took place 30th of September, 3 months to the end of the year, or take place 30th of November or 1st of December, which is a month to the end of the year. The question is, the principles still remain the same, only that the dynamics is what differ and which we need to take into consideration. And what is the dynamics? The dynamics is our ability to determine what is the pre-acquisition profit and what is the post-acquisition profit. And to do that, we need to more or less have some underlying understanding of the principle. Now, what do we do? You need to ask yourself a very simple question. The company you are dealing with that you have acquired the business, do they have a robust accounting system, especially the one that more or less update their management account every month to ascertain what the position is at the end of each month? Or at least it's a PLC where, to a higher degree, by way of regulation, they are required to present interim financial reports, which are usually quarterly, where they present to the stock exchange and to the shareholders. In such situation, it might be easy to obtain what is the net worth as at the acquisition date. Otherwise, in most cases, especially for limited liability companies that are not quoted, you find out that most of the interim account or monthly account are not exhaustive enough to ascertain the true position. Rather, the true position is usually ascertained by way of audit at the end of the year. But what bothers us most is that as at the time you acquire, if you're able to obtain the true balance sheet position, there won't be a problem to determine what is the pre-acquisition reserve. But most times, you might not be able to determine such until the end of the year. Now, when we are at the end of the year, assuming audit position has been ascertained, how do we then determine pre-acquisition reserve? It's for us to look at the nature of the business and try to work back. What are we working back? We are trying to work back what will have been the reserve position as at the date of acquisition, which will be used to ascertain the amount of the net assets as at acquisition. What that simply means is that if, for example, a company is deemed to operate in a business where profits or where revenue accrues evenly. Revenue accrues evenly if a business does not operate in a seasonal nature or a cyclical nature. And what that presupposes is that a business such that once it earns revenue of 12 million naira in a year, you can easily see that on average, revenue for each month is about 1 million naira. Such company will be seen to operate without seasonality or non-cyclical position. Okay, in that situation, if such company made profits of 6 million naira in the year, we can averagely conclude that such profit was made by making 500,000 naira per month for 12 months. Now, why are we assuming this? It's because if our position is not exactly known as at acquisition date, because the acquisition took place 1st of April, 3 months after the year has commenced. And as at the end of the year, we are aware that the reserve stood at 50 million. But at the beginning of the year, the reserve stood at 38 million. Therefore, we can simply assume that if reserve at the beginning of the year was 38 million, and the reserve at the end of the year stood at 50 million, it means the profits that was made, assuming there was no distribution in form of dividend during the year, will have been the difference between the 38 million and the 50 million, which is 12 million naira. Now, if we now assume that profit accrues evenly, it then means that 12 million naira will be divided by 12 to say 1 million naira was a profit made in each month of that year. And if that is the case, we can conclude then that in January, February, and March, 1 million times 3 months make 3 million made in that period. If we add that 3 million to what our reserve was as at 1st of January that year, it will be 38 plus 3, which gives us 41 million naira. Therefore, it means 41 million naira is our pre-acquisition reserve, which was the reserve as at 31st of March, 2020, for example. We then presupposes that from April 2020 to 31st of December 2020, which is 9 months, such constitute post-acquisition, which means since the profit accrues evenly, we have 1 million naira. 1 million naira times 9 months give us the 9 million naira, which is the difference between 41 million naira pre-acquisition and 50 million naira the reserve as at the end of the year. That is the simplest way we can even split and work back our profit position in a situation where we have acquisition during the year, where we don't have a robust accounting system that determines what is the true worth as at the point of acquisition. That is on one side. The reality also is this: how many companies can boast of the fact that their revenue is not cyclical or their revenue is not seasonal? By nature of some businesses, it is more seen that at some period of the year, the revenue is far more or lower than other periods because of the seasonality involved. And if that is the case, another thing we need to take note of is, do we understand such nature of the business so that we can be able to determine how do revenue accrue? And on that basis, we'll be able to apportion profit to various months within that year, with the whole essence of determining what is our pre-acquisition reserve and what is our post-acquisition profit or loss. And we are going to look at various scenarios to that. And also, there are other ways to which such can be determined. For example, information can be provided to you to show that at a point in time, at the beginning of the year, the reserve was so much. At another point in time, estimate of profit was made, and it has shown that there is a profit of so much. If I know such information, I can use that to work out what will have been my reserve at any point in time, which means with mosaic information, with skeletal information and details, we can be able to ascertain what is our pre-acquisition profit or reserves and what is our post-acquisition profit or loss. And what we're going to do invariably is that we're going to look at practical situation or scenario that will give us such ambience to ascertaining what could likely be our pre-acquisition profits and what could likely be our post-acquisition profit. Now, to do that, I think we'll make use of this illustration, which I'm going to cut out from this material. Any question before we proceed? Any question before we proceed? Okay, if there's no question, I shift to my whiteboard. Today is day 14. Acquisition during the year. Okay, let me bring this question forward. I want somebody to read the question.
Okay.
Are we there?
Yeah, I'll read it. Illustration 2. Arsenal acquired 70% of the ordinary shares of Manchester United on 31st May 2015. The retained earnings of Manchester United was 26 million naira as at the beginning of the reporting period, 1st January 2015. Statement of financial position as at 31st December 2015, Arsenal and Manchester United. Property, plant and equipment, 500 million naira for Arsenal, 240 million naira for Manchester United. Investment in Manchester United, 250 million naira. Current assets, Arsenal, 140 million naira. Manchester United, 180 million naira. The total is 890 million naira for Arsenal and 420 million naira for Man United. Share capital and reserves. Equity share capital at 1 naira per share. 600 million naira for Arsenal, 250 million naira for Man United. Reserves, that is retained earnings, 240 million naira for Arsenal, 50 million naira for Man United. The total equity is 840 million for Arsenal and 300 million for Man United. Current liability is 50 million for Arsenal, 120 million for Man United. So total equity and liability is 890 million naira for Arsenal and 420 million naira for Man United. Prepare the consolidated statement of financial position as at the operating dates, assuming A, profit accrues evenly during the year, and B, profit is in the last quarter, that is 4%, that is fourth quarter, doubles than the first, second, and third quarter of the year.
Okay. Now, what matter here is, if you check the question, you might be misled to assume that 26 million naira is pre-acquisition profit, whereas it is not. Rather, it is a pre-acquisition retained earnings as at the beginning of the reporting date, which was 1st of January 2015. But when did acquisition take place? Acquisition took place 5 months what? After. Now the question then is, we don't know what the reserve was as at this point, other than this information made available. Now let us start our solution from A. They said to be able to determine what the reserve was as at this date, let us for this business assume that profit accrues equally over the year. What will happen in that situation? First, don't forget our group structure. What percentage is that? 70%. What is our NCI? 30%. What is our date of acquisition? 31st April, 31st May 2015. What's our date of consolidation? 31st 12, 20 what? 15. Now, if you check this period, this is 7 what? Months from the date of acquisition to our reporting date. Whereas the year begins, beginning of the year, boy, was 1st of what? 1st of January 2015, which when you compare with this date, it is 5 months into the year that the acquisition took place. All in all, this gives 12 months, full year. Okay, now let's look at scenario 1. Scenario 1 says profits accrue evenly. Evenly means equally across the year. Now, let me draw up a line, a timeline. Assuming this is a straight line, the year begins, beginning of the year, boy, on 1st of January 2015, and the year end of the year, or the date of consolidation is 31st December 2015. Now, at this date, the reserve was plus 26 million. And as at end of December, the reserve has grown to what? 50 as at 31st December 2015. How come it disappeared? I didn't save it. Again, beginning of the year, 1st of January 2015. End of the year, which is the same thing as date of consolidation, 31st December 2015. Okay, this year I said what we had was plus 26. And at the end of the year, we have plus what? 50. Now, what has transpired between beginning of the year and what? End of the year, what has transpired?
Acquisition.
No, I'm talking about what has allowed 26 million to grow to 50 million. Is that it has grown by 24 million during the year, which should represent a profit for the year. Does that make sense? Because what impact your retained earnings from what it was at the beginning and what it is at the end, assuming you have not paid that dividend, is your profit for the year. If that is the case, and don't forget, this year can be broken down as follows into months. January, February, March, April, May, June, July, August, September, October, November, and what? December. Now, when did the acquisition take place? The acquisition took place on the 31st of May, 2015. 31st of May, 2015, should be, let's trace it out. This will have been 1st of January. This will have been 31st of January, which is 1st of February. This will have been 28th of February, today's. This will have been 1st of March. This will have been 31st of March, which is 1st of April. This will have been 30th of April, which is 1st of May. And this will have been what? 31st of what? May. I can trace it up. Which is the date of what? Acquisition. 31st of May, 2015. Which is what? X. And the X is what? Unknown. Which means if you recollect, the 5-month period here is our period of pre-acquisition, while the 7-month here is a period of what? Post-acquisition. Therefore, the same thing happens here. It then means that my period here, if I trace it backward, is my pre-acquisition period. And my period here, if I trace it forward, is my what? Post-acquisition period. Which means in this 12 months of the year, I have section of it that was existing or that has occurred before I acquired. And the other part, the period to which I've taken what? Over the affairs of the subsidiary. Now, if we look at it like that, let us assume we allocate points to each month of the year. Let us assume we allocate 1 point to January. Who can tell me the point I will allocate to February and why? If I give 1 point to January, what will I give as point to February?
I think it should be 1 if we are assuming even distribution of income.
Yeah, what it means that it should be 1, because you have assumed here that Whatever you generate in January, you generate it in February or to what? December, which means I give 1 point across board on the premise that profit accrued evenly. Now, how many points make up this acquisition period? How many points? 1, 2, 3, 4, and what? And 5. Okay, I'll put here 5 points. How many points are post-acquisition? 1, 2, 3, 4, 5, 6, and what? 7. 7 points. Therefore, which means this 24 million, by this point, I can use it to split the profit into pre-acquisition and what? Post-acquisition. What is the ratio I would use? Is that point? 5 points. Ratio what? 7 points. If that is the case, what then should I do? I can come back and say, therefore, of this 24 million, 5 over what? 12. How do I get 12? 5 plus 7 is what? 12. We represent pre, and why 7 over what? 12 of that 24 million will represent what? Post. Therefore, what is my pre-acquisition? My pre-acquisition here is 5 over 12 times this should give me 10. And here, 7 over 12 times 12 should give me 14. What it simply means is that from year to year, what you have made in that 5 months is 10 million profits. While what you have made in the next 7 months, from year to year, is what? 14 million. Now, that presupposes that my pre-acquisition profits or my pre-acquisition reserve, as the case may be, as at 31st of what? May 2015 will be what I have at the beginning of the year, which is what? 26 plus the 10 million that I've made in this year, in these 5 months, that will gross it up to what it is here, which means 26 plus 10 million will give me what? 36, which means I'll come here and say 36 million naira, 26 million naira plus what? 10 million naira will give me what? Sorry, 26 million, not 36. Will give me what? 36 million naira, which is my pre-acquisition, which means my X here equals what? 36 million. Now, 36 plus 14 will give you 50, which then means that my post-acquisition profits which is 7 months, will be 14 million. Which then means that when we add 36 plus 40 million, it will give us what? 50 million. That is how we apportion profits evenly. So my system is routine, or I don't know what's going on. So I don't know what's going on. Okay, but before it comes back, let me share this with you. The same thing we've done just now is what is replicated here. Can somebody take us through this and liken it to what we have done, we've just done now? Shagun, can you take us through?
Okay. What this diagram is simply saying is that the beginning of the year is 1st of January 2015, and I mean the beginning of the year is 1st of January 2015, and the date of consolidation is 31st December 2015. But the acquisition took place during the year, which is 31st May 2015. So the 10 million we are seeing there is only showing the profits between 1st of January and 31st of May. Ordinarily, the pre-acquisition profit is 26 million. The profit as of reporting period is 50 million. And the post-acquisition profit is 36 million. But because acquisition took place during the year, we cannot say the pre-acquisition profit is 26 million. So we have to split it and apportion that 36 million evenly for the 12, evenly for the 12 months. And if we should divide the 36 million by 12, that will give us something like 3 million every month, if I'm correct. So we are going to add that portion for 5 months. That is about 15. Okay, we are adding 10 million. We are adding 10 million to 26 million, which will give us the pre-acquisition profit as at 31st of May. So the pre-acquisition profit will now be 36 million, while post-acquisition profit will be 14 million. So if I may ask, what is this 36 million doing there?
What is what?
The 36 million naira, what does it represent?
That's the date of acquisition. That's date of acquisition.
Okay. So it's all right. But okay, here the 24 million we are having represents the the profits between 1st of January 2015 to 31st December 2015. So it is this 24 million that has to be splitted for the 12 months, and the proportion of the 5 months between 1st of January to 31st of May will now be added to the 26 million, which gives us 36 million as at 31st May 2015. And that represents our pre-acquisition profit. So our post-acquisition profit will now be this 24 million minus 14 million. Our post-acquisition profits will be, I think I'm getting something wrong.
No, it's the same thing. There are different approaches to getting it.
It's all right. Will be 24 million minus 40 million, which will give us, I think, yeah. So that's just the explanation of apportioning profit evenly during the year.
Now, if that is the case, let's go back to where we are providing solutions to this. Now, let's determine our goodwill, if any. What is our cost of business combination? Who acquired? Back to our question. ASNA acquired. ASNA's investments in Manchester what? United. How much was the investment? The investment was 250. NCI will recognize 30% of the net worth, which we have not yet determined. What is the net assets of Manchester United as at the date of acquisition? Is the share capital and the pre-acquisition reserve. What is the share capital? The share capital is 250, while the pre-acquisition reserve is 36. 250 and 36. That gives us what? 286. Therefore, we need 30% of 286 million. What does that give us from my own calculator? $286 times 30% to the next decimal or one decimal place is 85.8. 85.8 plus 250 gives me 335.8. And if I take away 286, it gives me 49.8 as my goodwill. What is my NCI? And consolidated reserve. Consolidated reserve and what? NCI as at 31st December 2015. Consolidated reserve, NCI. What is ASNA's reserve as a standalone business? ASNA's reserve as a standalone business was 240. What is the amount of NCI as at acquisition date? That is 85.8. What is the share of post-acquisition profits? The share in ratio 70 to 30. Why? Because that is the ratio of the stake. 70-30 of what? Of 14 million. 70% of 14 million is 9.8. And 30% of 14 million is 4.2. This gives me 90, and this gives me 249.8. Does that make sense? Okay. Therefore, we can construct our balance sheets. Let me try and go up and copy a balance sheet. Okay, I might try to put my own balance sheet now instead of me to copy one. Okay, my balance sheet. Arsenal Group, consolidated statement of financial position as at 31st December 2015. I'll try to put these two side by side, which we're going to see later. All figures in millions. We start with assets. Non-current assets. Okay, what is the first item we have there? We have property, plant, and equipment, which is 502.40. Property, plants, and what? Equipment. 502.40. That should give me what? 740. The next one is that we have goodwill. And the goodwill in this case was 49.8. 49.8. When we sum that together, it gives 789.8. Current assets. What do we have? We have 140. and 180. 140. That is what? 320. All things being equal. What is my total assets? 320 plus 789.8 gives me 1109.8. That's my total assets. This total assets is financed by equity and liabilities. And my equity comprises of share capital and reserves. What's our share capital? It's for Arsenal, as in Arsenal alone. Our share capital for Arsenal alone is 600. Our retained earnings or reserves is as consolidated. And that, under this, stood at 249.8. And that gives us what? 849.8 as our equity. Attributable to Arsenal. What about our equity attributable to non-controlling interest? What we have here is 90. I come here, I say what? 90. That should give us 939.8, which is our total equity. Thereafter, we'll consider our liability, and the only group of liabilities here are current liabilities. And here we have 50 and 120. $50 and 120, that's what? 170. All in all, our total equity and liabilities stood at 939.8 plus 170. That equally gave us 1109.8. Now, this solution is on the premise of assuming profit accrues evenly. Assuming profit accrues evenly. Okay. Now, let us now move to B that says profits in the last quarter, that is quarter 4, double that of the first quarter or second quarter or third quarter of the year. Who can interpret what that statement means? Who can interpret that statement? Who can interpret this statement, please? Profit in the last quarter doubles that of the first or second or third quarter of the year.
Okay.
Can I?
Who can interpret it?
Okay, can I try?
Yes, ma'am.
Okay, so to my understanding, it's saying that this one that said profit accrues evenly, and we're using 111 that we used in calculating. So if in 4 quarters now, so that means in the first 3 months, if the profit in the first 3 months is 1 each, then the profit in the last month, that's in the fourth quarter, will be 2. That's to my understanding.
Okay. Who else?
Yes, exactly what she said, I think. So it means the last quarter we generate half of the profit, whereby the first 3 quarters we share the other half of the profit.
No, is that what she said?
Yeah, that was what she said.
Madam Oladokun, is that what you said?
You said it in another way. Because that's the meaning. If you
Okay,
split it into 2.
let me give you a clue. Let me give you a clue. Last quarter is quarter 4.
Yeah.
Let us assume quarter 1 made profit of 100 naira. Tell me what quarter 2, quarter 3, and quarter 4 will have made, given that quarter 1 made 100 naira.
And so, based on that statement, quarter 1, quarter 2, quarter 3 will make 100. Then quarter
No.
4.
You have not answered my question. I said quarter 1 alone on its own made 100 naira. Therefore, tell me what quarter 2 will have made on its own, what quarter 3 will have made on its own, and what quarter 4 will have made on its own.
Are we assuming or is based on the calculations that we had here?
No. You're not getting me.
Okay.
It's explicit here that forget calculation. They said profit in the last quarter doubles that of the first quarter or second quarter or third quarter. That is what was given to you.
Okay.
And I want to assist you now to say, I know what the profit of the first quarter, first number 1 quarter is. And that profit is 100 naira. Now use that information and knowledge you have to estimate what the profit of second quarter would be alone, what the profit of third quarter would be alone, and what the profit of the last quarter would be alone.
Okay, so the second quarter profit would be 100 naira. The third quarter profit would be 100 naira. Then the fourth quarter profit will be 600 naira.
How do you arrive at 600 naira for the fourth quarter?
So if profit in the last quarter doubles that of the first, second, and third. First, second, and third, if it is 100 naira each, profit of the last quarter double it. So double of 300 naira.
Okay, can you read what is there again? Can you read this sentence? Let me help you highlight so that you can read carefully. I want you to read carefully. Oh yeah, start like this. I'm pointing into the. Oh yeah, start.
Profit in the last quarter, that is fourth quarter, doubles that of the first, second, or third quarter of the year.
But you are using the word and.
Okay, oh.
What does that mean to
So,
say oh? Which
oh,
means
that means that
what this
either
comma
double
stands
of
for?
either. Okay.
What this comma stands for here is already defined by all to say we are putting 1, 2, 3 on the same scale, not together. Do you get it, madam?
Yes, sir.
Now, if that is the case, now use that illustration to answer my question. If first quarter is 100 naira, what will be the second, third, and the last quarter? Independently.
So how do I assume without figures? If
No, I've
first
given
quarter
you
is
100 naira. I've given you 100 naira for
okay.
first quarter. What will be second,
Okay.
third, and last?
If the double is uh, if okay, I would say that the first quarter will be 200.
So pick
That's
it
the
one by
first.
one. What will be the second quarter?
I'm not sure I can answer that. I'm not sure.
Okay, who can assist?
Okay, let me try. Based on this assumption that the last quarter, fourth quarter doubles that of first, second, third, it means if first quarter profit is 100, second quarter will also be 100, third quarter will also be 100, while the last quarter that doubles will be 200.
Which means the clarity here is that profit accrues evenly between first, second, and third.
Exactly.
But since they accrue evenly, any of them you pick, when you compare it with the fourth quarter, that of the fourth quarter will be twice of it. Is that not what it is?
Yes.
That is it. We need to open our mind to all of those details. Otherwise, we might miss it out. Now, if that is the case, let us now go back. Let me copy this and use it to also answer our B. Now, what it means is that for my B, profits. Last quarter is quarter 4. Is twice of quarter 1, which is the same thing as twice of what? Quarter 2, which is same thing as what? Twice of what? Quarter 3. That's what it means. If that is the case, let me rub this up. Okay, we return back to where we were before. Now, in this question, they gave us information about quarters, which means our timeline has to be divided into quarters. How many quarters make a year? There are 4 quarters in a year. Therefore, I'll make this Q1, make this Q2, make this Q3, and Q4. Now, if we assume such, I will say first quarter at 3 points. How many months make a quarter? How many months make a quarter?
3 months.
Okay, therefore I can divide this into 3, which is January, February, and what? March. How many months? 3 months. Now these 3 points, I can share it among the 3 months equally as what? 1 point, 1 point, 1 point. Now, since quarter 1 and quarter 2 are the same, how many points will I also decide to give quarter 2? I'll give quarter 2 how many points? 3 points as quarter 1. Is that not? How many months are in quarter 2? There are also 3 months, which are April, May, and what? June. That 3 points, I'll divide it among those quarters is also what? 1, 1, and 1. If I give quarter 1 3 points, I give quarter 2 3 points. What would I give quarter 3? Based on the information, it's also what? 3 points. And how many months are in quarter 3? There are 3 months. July, August, and September. And these 3 points, I can share it among them, 1, 1, and 1. How many points will I give to quarter 4? Who will answer? How many points to quarter 4?
6.
6 points now.
6 points, which is double. 6 points. And how many months are there? October, November, and what? December.
December.
How many points will I give to each month? 2,
2, 2, 2.
2, and 2. Now, let us trace our date of acquisition. When was the acquisition? 31st of May, 2015. Let us trace it. Where can we find 31st of May? This is beginning of January, beginning of February, beginning of March, beginning of what? April, beginning of what? May. But what we need is end of May, which is the beginning of what? June. Therefore, when we trace it up, this is our date of what? Acquisition. and we'll trace it down. We are looking for X, which is our reserve as at the date of acquisition. Now, what can we do? We ask ourselves, what are the points that falls before acquisition, which are pre-acquisition points? What are the points that falls post-acquisition? These are post-acquisition points. Now, points from this arrow downward are pre-acquisition. And can we count the points? 1, let me use my annotation. Oh yeah, count the points. Can we count the points? 1, are you there?
Yes.
2, 3, 4, and what?
5.
5. Which means what we have here is 5 points. Okay, let us count from here. 1, 2, 3, 4. What is this here?
6.
6, yeah.
8.
And here?
10.
Okay. What this point is representing is that the weight here is higher than the weight here because of the principle that in one quarter, they get more profit than the other quarters. Now, we move further. If that is the case, let us now use that ratio. 5 over, this one is 10, Abi? This is 10 points. $10 points. Therefore, 5:10. What will be the base? It will now be 5 over what? 15 times what? 24. And the second one will be what? 10 over what? 15 times 24. If you do that, 5 divided by 15 times 24 should give me 8. And 10 over 15 times 24 should give me 16. Which means what I have from here to here is plus 8. And what I have from here to here is plus 16. Which means the same way we determine the other one, when the profit accrues what? Evenly, it's the same way we are going to do this one. And what is it? It is 26 plus 8. $26 plus 8 million will give me how much? Will give me 34 million. And this will give me 16 million. Which means that is the position. This, my X, is now what? 34 million plus 34 million. That is that. Any question on that? Any question on that? Now, let us now, yeah?
Sorry, I'm joining the class late. Apologies for that. I want to ask, is there any other methodology about arriving at these points aside this?
There are thousands of methodology. What I'm laying down is the foundation of how can you share something on the basis of ratio. It's not accounting. I'm just trying to lay the foundation. The same thing, I can turn into a word problem where I'll tell you that given that ratio X to X is this, and the total amount is this, therefore, what can I get for this? Which means you can use it and solve it with mathematical equation. What we are trying to do is to lay the foundation for understanding that when you need to apportion things among people and they've given you a basis, how then can you use that basis to apportion? That's what we are saying. And there can be any basis given to you. This is just an illustration of one of those bases.
In addition, the fourth quarter, is it as a result of the fact that they say it's going to be double of, that's why we make those months 222?
That is what we have said. And when you check the question up there, they told us that quarter 4 profit is twice what you'll have made quarter 1 or 2 or 3.
Okay.
Okay, I want somebody to look at this and also use it to explain to the class for this second one. This is the second one. Okay, can somebody explain it?
Okay, let me just explain it based on what you said, the second one. So the profit that was made for the whole year is 24 million. And for the last quarter, which is the fourth quarter, the profit made in that last quarter was double the profit made in every other quarter. So we now made a ratio, that is, each month has 1 point. But the last quarter's month, we are given 2 points, which now made it about 50 points in total.
Continue. I think his network is freeze.
So the last quarter months have 9 points. So out of those 9 points, 5, that is 5 points. So five over 15, 5 out of 15.
I think his network is bad. Can Nuruddin continue from there, please?
Okay, thank you very much. What is explaining is, let me continue. From this diagram, 1st of January 2015 serves as commencement period date of the entity. Then 31st December serves as the end of the accounting period, while 31st May 2015 serves as date of acquisition. Okay, now from beginning of the year, our reserve stands at 26 million. Why at the end of the accounting year, reserves stands at 50 million. Meanwhile, we determine the profit for the during the period as 24 million, meaning profit from January 2015 to December 2015 is 24 million. Okay, now to determine what will be our pre-acquisition profit and post-acquisition profit, they've given us clue that first, our fourth quarter profits will be doubled of first, second quarter, or third quarter, which made us this simple analysis that, okay, for Q1, Q2, Q3, we gave them 111 points. But for Q4, which is doubled of Q1, Q2, Q3, we gave them 222 points. However, counting our points, we look at the period that serves as our date of acquisition, which is 31st May 2015. Okay, we count the number of points that fall within the period from January to 31st May, which is 5 points. Okay, we now counted the other hand, the other points which fall after the acquisition date, which is when we counted it, we have the summation to be 10 points, meaning that pre-acquisition points is 5 points, post-acquisition points is 10 points. When we sum up the 2 points, it gave us 15, which serves as our base. Now, to determine what will be the first proportion, we have, since we have 5 points pre, we have 5 over base, which is 15, times what we have as our profit, 24. And that gave us 8 million.
Would you like shakara too much?
Then we look at the other one, we have 10 points over base, which is 15, times profit during the period, which is 24 million. That gave us 16 million. Now, to determine our pre-acquisition profits, our 8 million plus 26 million, which we have as a reserve, pre-acquisition reserve, it now give us 34 million, being our pre-acquisition reserve. Whereas our post-acquisition reserve now stands at 16 million. Thank you. You are on mute.
Thank you very much. Any question at this point before we proceed? Any question? Any question at this point before we proceed? Okay, if there's no question, let us proceed. Now let's determine our goodwill. Okay, I've copied and pasted the same format we had in the first one. Now, ACCA investment in Man U has not changed from 250. Okay, NCI is 30%, but we still don't know what the value is. What is the share capital of Man U? I think the share capital still remains at 250, which has not changed. And the pre-acquisition reserve from what we just completed is what? is 34. 34, unlike before when it was 36. 34 plus 250 is 284, which means we are looking for 30% of what? 284. Thirty percent of 284 in one decimal place, what is it? From my own calculator is 85.2. You may confirm. 85.2 plus 250 gives me 335.2. 335.2 minus 284. I have 51.2, which is my goodwill. Now, Arsenal's reserve. Arsenal's reserve is what? Is 240. And NCRs at acquisition is 85.2. Why, as the post-acquisition profit is 16. Therefore, can we share 16? 70% of 16. 11.2. And 30% of 16. 4.8. This to give me 90. And this give me 251.2. Therefore, we can come back and put on the side B. What is our PPE? Our group PPE for B still remain at same amount of 740. But what may have changed is the goodwill, which in this case, we said the goodwill is 51.2. 51.2 plus 740 will give me 791.2. While current assets still remain the same at 320. 320 plus 791.2 will give me 1111.2. Share capital of Arsenal still remains 600, but the retained earnings, I think you wiped up. I didn't save it. What was retained earnings again? I think
251.2.
16 times 0.7 gave us 11.2. And this gave us 4.8, 90 and 251.2. Let me save it. This is 600, which remains the same, while this is 251.2. And that gives me, sorry, let me be consistent with the column. What is our NCI? 90? I don't know why this is going off. I don't know why. 251.2, 851.2. And this is what? 90. That is what? 941.2. Okay, our acquired liability remain at 170. All in all, when we sum this up, we should have 1111.2. Any question here? Any question? Any question here? That summarizes all what we need to look at with respect to acquisition during the year. Any question on that? I await contributions or questions.
Okay, I would like to say this. Actually, the principle we try to understand here is the principle of acquisition during the year. However, all other postings, all other principles remain constant here. And in as much as you've adopted a simplest form to determine what will be the pre and post acquisition profits, I think it makes it a little bit understandable and clear to understand, because the only thing that can be a bottleneck is to determine the pre-acquisition reserve when the acquisition occurred during the year. But thank you for the method. It's very simple and easy to understand. Thank you.
Okay. Any other contribution? Any other contribution? Okay, if there's no contribution, I'm giving you this task, which is expected of you to complete now. Okay?
Okay, excuse me, I would like to ask a question.
Yeah.
Yeah, ordinarily when we calculate depreciation in accounting, so when it is maybe within the month, maybe 16th or 17th or 18th, we usually assume that it's a whole month. So what if the acquisition now happens maybe on the 10th of a month or on the 18th of a month? Do we do that same assumption that if it happens very close to the end of the month, we take it as a full month. Or if it happens maybe some days after the beginning of the month, we take it as belonging to the previous month.
Okay, the first question I will also put back to you before we find solution to that problem is to ask ourselves a simple question. Why do you believe you are doing what you did with respect to having to buy an asset on the 14th of a month and decided to take it for a whole month, or you bought it at 20th of a month and you didn't depreciate it to that month to start the next month? What do you believe is the rationale for that?
Yeah, it's just for simplicity.
Are you sure?
Yes, I want to believe is to...
Okay, who else can contribute? Who else can justify why? Who can justify? Who can justify? I'm waiting on. We are professional accountants. Why was that done? Apart from saying that that's the policy of the company. Because the issue is this. Somebody has asked me before, what if this acquisition takes place on the 14th of the month? Therefore, are we going to also prorate 14th? I said, if we do that, I can also complicate the problem since you want to complicate it. What if it happened 2 o'clock in the afternoon? Therefore, we also prorate, Abby. What if it's not exactly 2 o'clock? It's 2 o'clock at like 2 o'clock, 15 minutes, 15 minutes after 2. What if I want to complicate it further, that it's not just 15 minutes, it's 40 minutes after 35 seconds, which means, again, that adds no value to the process, which means on the basis of materiality, that does not add value. Somebody said, but we bought the motor vehicle on the 28th of December. Why are we not depreciating for 4 days? What impact would that have? And don't forget, part of the things is that your system of accounting procedures and reporting, the cost of which should never outweigh the benefits. That's why you have cut-off procedures in every organization. They'll tell you any asset you buy before 15th of the month will go in as if it was deployed 1st of that month. Anyone after 15th will go in the next what? Month. Am I making sense, sir? And that is the position. Similarly, also in this case of acquisition, the lowest one we can go in acquisition is assuming the acquisition took place in a month, not trying to calculate the number of days, the number of hours, and that add no value in real life. Are you getting what I'm saying now? Which means presumably it is either it happened at the beginning of the year or at the end of the year, or at the beginning of a month or end of a month, not in between a month, even though it might happen reality as that, but we'll take the acquisition to has taken effect as at a particular time, either at the beginning of that month or what, end of that month, because it doesn't make a material what difference in that regard. Otherwise, we'll be calculating. If we want to complicate it more further, we'll now be asking, is it leap year or is it ordinary year? Therefore, is it over 365 or is it over what? 366. Do you get what I'm saying now? And that's just the position. I want somebody to read this question and I want you to do it on your own. Can somebody read this question? And we call it a day. It's left for you to do it and share solution amongst yourselves. Can someone read this question? Marian, can you read?
Int'l acquired 80% of the ordinary shares of Int'l on 1st April 2005. On 31st December 2004, Int'l's account showed a share premium account of $4,000 and retained earnings of $15,000. The statements of financial position of the two companies as at 31st December 2005 are set out below. Neither company has paid any dividends during the year. Non-controlling interest should be valued as full fair value. First shares was $2.50 to acquisition by the parents. Required, prepare the consolidated statement of financial position of Int'l at 31st December 2005. There has been no impairment of goodwill. Statement of financial position as at 31st December 2005 for Int'l and Int'l. Assets, non-current assets, property, plant and equipment. For Int'l, 32,000. For Int'l, 30,000. 16,000 ordinary shares of 50 cents each in Int'l is 50,000, which makes up 82,000. Current assets of Int'l is 85,000, while for Int'l is 43,000. Total assets 167,000 for Int'l and 73,000 for Int'l. Equity and liabilities. Equity, ordinary shares of $1 each, 100,000 for Int'l. Ordinary shares of 50 cents each, 10,000 for Int'l. Share premium account, 7 share premium accounts, 40,000 and 39,000 for Int'l. Retained earnings is 40,000 and 39,000. Current liabilities, 20,000 for each of them, and total equities and liability 167,000 for Int'l and 73,000 for Int'l.
Okay, that's what we stop for today. Thank you very much. And God bless you. I'll share this with you all. Bye.